Welcome to EduTube, your trusted companion for zero-semester virtual university Pakistan exam prep. In today's video, we will be working through 30 multiple-choice questions, MCQs, based on Chapter 17 from your MATH001 course. All questions and content are strictly aligned with the official LMS handouts provided by Virtual University, so you can be sure you're preparing exactly what you'll see on your final exam. The topics covered include discounts, simple and compound interest, and calendar-related concepts. Whether you're revising or just starting to prepare, we simplified everything for you to understand easily. Let's get started. Lecture 17. Applications of Basic Mathematics MCQs with explanations. What is the primary purpose of calculating a discount? A. To increase the selling price. B. To reduce the cost of goods. C. To reduce the original price of an item. D. To increase profit margin. Answer. C. To reduce the original price of an item. Explanation. The purpose of a discount is to lower the original price of an item, often used to attract customers or clear out inventory. Discounts are offered as a percentage of the price. Which of the following is the formula for calculating simple interest? A. I equals P times R times T, 100. B. I equals P times R times T. C. I equals P times R, T. D. I equals P times T. Answer. A. I equals P times R times T, 100. Explanation. Simple interest is calculated using the formula I equals P times R times T, 100, where P is the principal amount, R is the rate of interest per annum, and T is the time in years. Simple interest is calculated on which of the following? A. Principal amount only. B. Principal and interest together. C. Interest alone. D. Only the final amount. Answer. A. Principal amount only. Explanation. Simple interest is calculated only on the principal amount throughout the entire period. It does not take into account the interest that has already been added to the principal. What does compound interest take into account that simple interest does not? A. Only the principal amount. B. The principal and previously earned interest. C. Only the interest. D. The rate of interest. Answer. B. The principal and previously earned interest. Explanation. Compound interest is calculated on both the principal amount and the interest that has been accumulated over time. This makes it different from simple interest, which is calculated only on the principal. Which of the following is true about compound interest? A. It is calculated only on the principal. B. It is calculated on the principal and accumulated interest. C. It is the same as simple interest. D. It is calculated annually only. Answer. B. It is calculated on the principal and accumulated interest. Explanation. Compound interest includes both the principal and the interest that has been added during each period, making it more beneficial for investments than simple interest. The formula for calculating compound interest is A. E equals P times 1 plus R, 100, caret T. B. A equals P times 1 R, 100, caret T. C. A equals P times R times T. D. A equals P plus R times T, 100. Answer. A equals P times 1 plus R, 100, caret T. Explanation. The compound interest formula is A equals P times 1 plus R, 100, caret T, where A is the amount after interest, P is the principal, R is the rate of interest, and T is the time in years. What does the term average due date refer to in financial calculations? A. The date when a payment must be made. B. The average date when an invoice is issued. C. The date that is calculated by averaging the due dates of multiple payments. D. The first payment date. Answer. C. The date that is calculated by averaging the due dates of multiple payments. Explanation. The average due date is calculated by averaging the due dates of all payments due in a period, often used to simplify payment management. In the context of interest on drawings, which of the following is true? A. Interest on drawings is added to the capital account. B. Interest on drawings is charged on the total drawings made by a partner. C. Interest on drawings is a form of income. D. Interest on drawings is paid by the business owner to customers. Answer. B. Interest on drawings is charged on the total drawings made by a partner. Explanation. Interest on drawings is charged to a partner's capital account based on the total amount withdrawn by them. It is calculated because the partner has used business funds for personal purposes. Interest on drawings is calculated based on which factor? A. The principal amount drawn. B. The time for which the amount is withdrawn. C. Both the principal and the time period. D. None of the above. Answer. C. Both the principal and the time period. Explanation. Interest on drawings is calculated based on the amount withdrawn and the time period for which it was used. The longer the time or the larger the amount, the more interest will be charged. How does the calendar relate to financial calculations? A. It is used to calculate time periods for interest. B. It determines the cost of products. C. It helps in calculating discounts. D. It sets the fixed rates for all financial transactions. Answer. A. It is used to calculate time periods for interest. Explanation. The calendar is important in finance to determine the exact number of days or months for which interest should be calculated, affecting both simple and compound interest calculations. Great progress! Remember, these questions are directly linked to your LMS handouts, so you're getting the most relevant practice possible for your final exam. The more you practice, the more familiar these questions will seem when you're sitting in the exam hall. Let's dive into the next one. A loan of $5,000 is taken at 10% annual simple interest for 3 years. What is the interest earned? A. $1,500. B. $500. C. $1,000. D. $2,000. Answer. C. $1,000. Explanation. Using the simple interest formula, the interest is I equals P times R times T, 100 equals 5,000 times 10 times 3, 100 equals 1,500. The total interest earned after 3 years is $1,000. A person invests $2,000 at a compound interest rate of 5% per annum for 2 years. What will the total amount after 2 years be? A. $2,100. B. $2,200. C. $2,500. D. $2,050. Answer. A. $2,100. Explanation. Using the compound interest formula, E equals 2,000 times 1 plus 5 100ths squared equals 2,000 times 1.05 squared equals 2,100. So, after 2 years, the total amount will be $2,100. 13. What is the formula for calculating the average due date, ADD, for payments? A. Sum of all due dates, number of due dates. B. Sum of all payments, number of due dates. C. Sum of all payments, total time. D. Sum of all principal amounts, number of due dates. Answer. A. Sum of all due dates, number of due dates. Explanation. The average due date, ADD, is calculated by averaging the due dates of all the payments. This helps to determine an overall due date for convenience when managing multiple payments. 14. In compound interest, the interest earned in the second year is A. Less than the interest earned in the first year. B. Equal to the interest earned in the first year. C. More than the interest earned in the first year. D. Not related to the first year's interest. Answer. C. More than the interest earned in the first year. Explanation. In compound interest, interest is calculated on the accumulated amount, principal plus interest. Therefore, the interest earned in the second year will be greater than the first year as it includes the interest from the first year. 15. What is the primary difference between simple interest and compound interest? A. Simple interest is calculated on the principal only, while compound interest is calculated on the principal and accumulated interest. B. Simple interest is calculated annually, while compound interest is calculated monthly. C. Simple interest earns more money over time than compound interest. D. Compound interest does not depend on the principal amount. Answer. A. Simple interest is calculated on the principal only, while compound interest is calculated on the principal and accumulated interest. Explanation. The key difference is that compound interest takes the previously earned interest into account, while simple interest is calculated on the initial principal only. 16. If you deposit $1,000 in a bank at an interest rate of 5% per annum for 3 years with compound interest, what will the total amount be after 3 years? A. $1,050. B. $1,157.63. C. $1,200. D. $1,100. Answer. B. $1,157.63. Explanation. Using the compound interest formula, E equals P times 1 plus R, 100, caret T equals 1,000 times 1 plus 5 100ths cubed equals 1,000 times 1.157625 approximately equals 1157.63. 17. Which of the following is true for simple interest? A. Interest is calculated only on the principal amount throughout the investment period. B. Interest is calculated on both the principal and the accumulated interest. C. The total amount grows exponentially. D. Simple interest is used for long-term investments only. Answer. A. Interest is calculated only on the principal amount throughout the investment period. Explanation. In simple interest, the interest is calculated only on the initial principal, without considering the interest accumulated over time. 18. In which situation would you use simple interest over compound interest? A. When the investment period is long and you want more earnings. B. When you want to maximize your earnings over time. C. When the loan period is short. D. When the interest rate is low and the loan is for a long period. Answer. C. When the loan period is short. Explanation. Simple interest is often used for short-term loans and investments as it is easier to calculate and doesn't involve compounding, making it simpler for smaller amounts and shorter periods. 19. What is the main purpose of calculating interest on drawings in partnership firms? A. To increase the value of drawings. B. To reduce the partner's capital. C. To compensate the firm for the partner using firm's funds for personal use. D. To add to the partner's salary. Answer. C. To compensate the firm for the partner using firm's funds for personal use. Explanation. Interest on drawings is charged to the partner's capital account because it compensates the firm for the funds used by the partner for personal purposes. This ensures fairness to the other partners. 20. A loan of $5,000 is taken at 6% per annum simple interest for 2 years. What is the total interest paid on the loan? A. $300. B. $600. C. $1,000. D. $400. Answer. A. $600. Explanation. Using the simple interest formula, I equals P times R times T. 100 equals 5,000 times 6 times 2. 100 equals 600. Great progress. Remember, these questions are directly linked to your LMS handouts, so you're getting the most relevant practice possible for your final exam. The more you practice, the more familiar these questions will seem when you're sitting in the exam hall. Let's dive into the next one. 21. What does the term discount typically apply to? A. Products on sale or special offers. B. The interest rate on loans. C. The principal amount in simple interest. D. The rate of return on investments. Answer. A. Products on sale or special offers. Explanation. Discount refers to a reduction in the price of products, often to attract customers or as part of a special promotion or sale event. 22. What happens to the total amount if the time period for compound interest is increased? A. The total amount stays the same. B. The total amount decreases. C. The total amount increases. D. The interest rate increases. Answer. C. The total amount increases. Explanation. In compound interest, the longer the time period, the greater the effect of compounding, which leads to a higher total amount due to the continuous accumulation of interest. 23. What is the significance of the calendar method in financial calculations? A. To calculate discounts on large sums. B. To track monthly payments. C. To determine the correct number of days between interest calculations. D. To simplify the overall loan amount. Answer. C. To determine the correct number of days between interest calculations. Explanation. The calendar method helps calculate time periods accurately for interest calculations, as different months have different numbers of days, which can affect interest. 24. Which type of interest is typically used for long-term loans or savings? A. Simple interest. B. Compound interest. C. Discount interest. D. Average interest. Answer. B. Compound interest. Explanation. Compound interest is generally used for long-term loans and savings because it allows interest to be earned on previously accumulated interest, leading to greater returns over time. 25. The compound interest formula includes which of the following? A. Only principal. B. Only rate of interest. C. Principal and accumulated interest. D. Interest rate and time period only. Answer. C. Principal and accumulated interest. Explanation. The compound interest formula accounts for both the initial principal and the interest that has been accumulated over time, making the total amount grow faster. 26. What is the formula to calculate simple interest? A. I equals P times R times T. B. I equals P plus P times R times T. C. I equals P times R, T. D. I equals P times T. Answer. A. I equals P times R times T. Explanation. The formula for calculating simple interest is interest equals principal times rate times time. 27. How do you calculate the final amount in simple interest? A equals P plus P times R times T. B. A equals P times 1 plus R times T. C. A equals P plus ID. A equals P plus R times T. 100. Answer. A equals P plus P times R times T. Explanation. The final amount in simple interest is the sum of the principal and the interest earned over time. 28. In compound interest, what does T represent in the formula equals P 1 plus R 100 caret T? A. Interest rate. B. Principal. C. Time in years. D. Amount. Answer. C. Time in years. Explanation. In the compound interest formula, T represents the time period in years for which the interest is calculated. 29. If the interest rate is 10% per annum and the principal amount is $2,000, how much interest will be earned in the first year using simple interest? A. $200. B. $250. C. $300. D. $500. Answer. A. $200. Explanation. Simple interest equals principal times rate times time equals 2,000 times 10 divided by 100 times 1 equals $200. 30. The formula for compound interest when compounded annually is A equals P times 1 plus R 100 caret T. B. A equals P plus P times R times T. C. A equals P plus R 100. D. A equals P times 1 plus R caret T. Answer. A equals P times 1 plus R 100 caret T. Explanation. The correct formula for compound interest when interest is compounded annually is A equals P times 1 plus R 100 caret T. Great job on completing the 30 MCQs for Chapter 17. You've made important progress in your preparation, and I'm sure you're feeling more confident. Always remember, we're following the official LMS handouts from Virtual University, so everything you've seen here today is what you need to know for your final exam. If this video helped you, make sure to like, subscribe, and share it with your fellow zero semester students. Also, don't forget to stay tuned for Chapter 18, where you'll continue working on MCQs to keep building up your knowledge for the exam. Best of luck with your preparation, you're doing amazing.